Dear all, here we are again with a virtual NBIM Talk. As a fellow fund manager, I have followed the fund from the sideline for many years, and I'm in awe of what the fund has achieved. During 2020, we have published several historic reviews documenting important aspects of the management of the fund. And today, we publish another review, Investing with Company Insight. My predecessor and former CEO, Yngve Slyngstad, is the editor and driving force behind these reviews. I hereby give the word to him.
NBIM today is one of the world's largest investors. We have nearly $1 trillion invested in the world equity markets. And I think some people are, of course, curious about how we have invested these funds in the equity market during the last 2 decades, and we have written a book about that. But we also today have with us the new CEO of NBIM, Nicolai Tangen, who has a long career and have built up a successful investment firm in London before he took over as CEO of the fund. Not a small task you have taken on, Nicolai.
No, that's for sure, and you know all about it. These are for sure some big shoes to fill.
The first 6 months as CEO, you have talked a lot about and put a lot of emphasis on communication. And why is that?
Well, communication, I think, is absolutely key to what we want to achieve here. And what we have seen is that there is a very clear correlation between how much people know about the fund and how much they trust the fund. And in this business, trust is absolutely key. Now, there are other reasons for communication too, because we want to attract the very best applicants for the jobs we have. We need the absolutely best and brightest, and so people need to know what it is. And then, of course, we have other stakeholders. You know, we communicate with the world out there, the politicians, the companies, and so on. So all this is important. And so we have put emphasis on the external communication, but also a lot on the internal communication, which clearly has been important through the COVID times.
So today we are coming out with this book, more than 100 pages about how we do internal equity selection, how we choose the best companies, how we are researching them, etc. You think that is something that is part of that communication drive as well?
Absolutely. So I'm just so happy that we are coming out with this book. You know, there has been a lot of discussion about this field amongst academics and so on. We are showing them that this is a great strategy. And we're also lifting up a lot of the people who have been instrumental to this. So I'm just so happy that you and some of our colleagues have spent time on this.
So when we're looking back, you know, results has been great. We have created a lot of extra value, but still we have had this discussion with an academic bent to it, with whether active management pays at all, and whether just taking additional risk if you're doing it, etc. I think in one sense, with the board recruiting you with your background, that question is kind of maybe not as relevant anymore. It's been settled once and for all, but still we need to communicate and talk about how we're doing it and how we're going to do the equity selection here. Yeah. So still some way to go here, I guess.
I think there is some way to go, but what is also very clear is that you need the active management because we also are active owners. And you cannot engage with companies and get them to sit down with you and talk to you about our thematic topics and so on if you don't know them. And the way you get to know them is through the active management. So it's a very it's completely key, and it goes like hand in hand.
And it kind of works the other way also. When we are having all these company meetings, the companies understand who we are and that we are long-term investors who have a common and mutual interest in long-term profitability.
Absolutely, absolutely.
So when you go to that research side, you know, we are invested in thousands of companies, but in reality, it's less than 1,000 companies we actually do in-depth research on. It's typically between 600 and 800 companies, but even that is a huge task.
Yes, it is a huge task. I mean, there are, in a way, two questions there. One is, do we need to own 9,000 companies, or is that too many? I think probably we don't need to own that many to get proper diversification. So that's an interesting question. And then, of course, how many can we cover and follow actively? Now, we have between 50 and 60 portfolio managers who do a tremendous job here, and so I think we can definitely do that. And then the question is, what additional resources do we put in here?
But this is not only resources. You will take this to the next level, and what is required?
Well, that's interesting. So first of all, we have a tremendous starting point. You know, we got great people, we got great methodology, we got great systems. So that's really been built up over the years, and strong starting points. I think there are a couple of things we can develop. I mean, one is learning from mistakes. I mean, that's one of the big things in my life, and I have made so many mistakes, but I try to learn from them. And the humbling thing about being a portfolio manager is you make, perhaps 48% mistake. I mean, if you only make 47% mistakes, you are a hero. And so that's why mistakes are important, because you need to learn from them. And we are now creating this new investment simulator where we put all this into a system, and where we can look at the type of weaknesses that and strength that the various portfolio managers have, so that their kind of pattern is being fed back to them when they put on a trade. I think we can do more on negative selection, i.e., get rid of things which are bad. And the amazing example last year from the fund was how we were pretty much out of Wirecard when that thing exploded. And it saved the fund an enormous amount of money. So through forensic accounting, through people who are specialists in discovering fraud and so on, I think we can do more. And then lastly, I would emphasize what you can do on mental resilience and how you can use sports psychology. You know, we now hired one of the top sports psychologists from the what is called Olympiatoppen, from the Olympic effort that we have. And we improve mental resilience, what we call bounce back ability. It's the ability to take risks even when you are down, and so on. And I think this would be very important factors going forward.
For those who know us, or for those who want to read this book, they will see that we structured a lot of our internal active equity management around sectors, giving individual people a defined industry to do their research in and do their work in. But in many ways, the traditional industry division is kind of challenged with all the technological changes who's going on these days. Do you think this model is kind of outdated?
Well, it's certainly a model which has worked well historically, but whether that's the model one should use in the future, I think one needs to look at and discuss. Interesting is so many industries have been disrupted now by various technological advances. Think about banking. I mean, the banking industry is completely transformed. Look at retail. The retail industry has been transformed. Travel and leisure is being transformed by what we're seeing on the technology side and so on. So I think it's an interesting discussion to be had for sure. I mean, what do you think personally?
Well, I think when we set this up and I came in here in more than 20 years ago, I think it was kind of the right thing to do, to focus on these industries, because what was happening there, and the really big thing in the corporate world, was globalization. And the companies went from their home market to go out and not only take, but to try to dominate international industries. And you could follow the companies out in the world by structuring your whole investments around sectors and global sectors, as we did. Now I think the really big revolution in the corporate landscape is not so much globalization, it's more digitalization and all the effects around that. And to a large extent, that actually transform what is an industry. And you can have new players coming suddenly from the left field without you seeing it, if you're focusing too narrowly in your industry definition. So I think what we have done, for instance, on the energy side, where we are managing our oil and utilities and our renewable investments in the same team, is one example of how you maybe need to look more on whole industry complexes and being open for a different way of looking at the world. So I think that's certainly one thing is worthwhile to look at.
When we are at kind of your reflections about the the history. The book is full of numbers, but just more on a personal note, what do you think are the most memorable things that you have experienced during this period?
Now, of course, if you write a book like that, it's going to be quite dry, and it's going to be numbers, as you say, and the truth is quite often in the numbers rather than the words. But of course, the memories will be more on the different aspect. And I think, what has been driving me is just the great people we have in the organization. I think it's just a privilege to work with so many good people. And I always said that, the first thing here is that we like to have people who's really good professionals, who know their work, who know their craft, but they have to be people who want to go to your workplace and spend time with every day. And traveling with them, seeing companies with them. We always used to take a week visiting companies in China, another week visiting companies in Silicon Valley. All that experience you can get there together with these great employees, I think it's been really fantastic.
What would you have done differently?
Oh, there's so many things. As you say, you learn from your mistakes. So the list will be very long if I start to do that. I think the first thing is that we have actually started to look a bit on this industry division. And that, of course, has been a quite defensive strategy, because if you do not take any industry deviation, you will not underperform a lot, but you can't outperform that much either. I think also we probably should have been even more stubborn on what we call capital strategy, which is described in this book, willingness to take larger positions. And, we had a few that didn't work out so well. And of course, you have to be willing to stand in the storm when that happens. But I think in a big scheme of things, we made some choices, and we could have made other choices, but it kind of worked out quite well when you look at the numbers.
Absolutely.
So when you look at this performance again, if you want to go out there and create significant excess return, you have to be prepared for years where you actually are losing money. And 2020 was a great year, but what if you had the same kind of loss in a year? How would you kind of deal with that, given that this is a public fund and is very kind of much in the public domain how well we're doing?
Yeah. No, the thing is that you can't beat the market if you are the market. And if you are the market, you will automatically go through periods with underperformance. And I think the key here is just communicate that properly. I think it's just absolutely key, which is why we're doing things like today. So that people can understand that you will go through periods like this. And I think one of the interesting things in investment management is that your process can be. The frustrating thing in a way with portfolio management is that in the short term there is no correlation between your process and the outcome, whilst in the long term there is huge correlation. So you can do a great job day in, day out, but you may have negative results in the short term. And so that needs to be properly communicated.
With regards to the size of the fund, and people say kind of too large now really to move, we have to buy a bit of everything, as we say. But still we have, for instance, our sector strategies, we have gone from $50 billion to $100 billion during the course of the last 2 years. Can we double again? Do you see any capacity limits here?
I don't really necessarily see any capacity limits there because one, I think the negative selection side, i.e. excluding companies which are bad, I think that can be done to a quite high degree. I think utilizing the forensic accounting side as well can help. I think what is important there is of course the liquidity, and that depends on how frequently you trade. So I think if you can extend the holding period and kind of compound and sit with positions for a longer period of time, then that's less of a question as well.
Yeah. When you built up your own firm, you had a quite clear investment philosophy. Many people will refer to it as buying quality companies. Is that a philosophy you intend to bring into the funds?
Well, there are many ways to skin the cat, and you have skinned the cat very successfully here with a different type of strategy. I think that if you want to have a longer holding period, you may want to zoom in a bit more on the quality end, because you have typically higher growth and higher return on capital, and so you can kind of compound the earning stream differently, and it requires less trading. I think there is another question as well, which is that on the quality side of things, you have less ESG potential problems, which is another factor. But the investment philosophy is something that we are working on and have worked on and will continue to work on over the next years.
So finally, Nikolai, you got the whole organization and the whole Norwegian population behind you in wishing success for the fund here. But what is driving you here, and when you go to work every day, what's the key?
The driver here is very clear. The oil fund is one of the biggest successes of this country. It's more important than ever before. Last year, it accounted for roughly 25% of the state budget. It is, a huge honor and responsibility to run the fund and to be the third person out. And so that's what I'm striving for, is to do a good job and try to continue the good development that has been before me.
Okay, Nikolai, I think we should take a break there and try to get some of the people who actually work on the strategy on a day-to-day basis into the session here. And thank you again, and all the best of luck.
Thank you.
With me today, I have our Chief Investment Officer for Equities, Petter Johnsen. And Petter, when you look back in the last 20 years, how would you say our investment strategy has developed during the course of this time?
I think the big change really has been the size of the fund. If you look when we started, there was nothing special about the fund. We had a small office in London, a couple of portfolio managers, all Norwegians. It was more known in Norway than internationally. If you look at the international marketplace, brokers, asset managers, but in particular the companies on the stock exchanges, we were really unknown at that time. But I think since then, it's been a phenomenal change. As we all know, the fund has become very large and it's become very well known here. And I think that you can see that in terms of where we stand now in terms of a setup. You know, we have a very international workforce for more than 20 nationalities. Our premises are great across the globe here. And we have, I would claim, state-of-the-art systems here. And also importantly, every day in our offices, international offices, there are meetings with the top companies, the CEOs, the CFOs on a daily basis.
So, of course, not only have we changed as a fund since we've grown so much, since we built up the organization, but the marketplace has changed as well. The companies has become larger, they are more global. And that must also have influenced the way that we are approaching the companies.
Yeah, it's no doubt that, as we know, stock picking, it is a very competitive business. And we as others, we have to adapt here to stay competitive. But I think we also should emphasize what has kind of remained constant in terms of the basic elements of the strategy, that we do specialize by sectors, or portfolio managers, they focus on a single sector. They do their own independent analysis, and they base this on building in-depth knowledge about the companies over time.
So you said that we're organized mainly around industries or sector teams, as we call it. And actually, when we started out in '99, that was definitely not the way that most fund managers had organized their research effort or the way they put up their investment mandates, quite simply because most of the client money was actually based on geography. Global equities or European equities and so on. So this was kind of a different starting point, but it has maybe served us well anyway.
Yeah, as you say, I think we made and maybe differentiated strategic decision to focus on sectors rather than geographies back in 1999. But if you look, especially, we would argue in terms of looking at larger companies, they have operations in many countries. Having focus on sectors rather than geography, we think makes sense. We thought it made sense then, 20 years ago, and I think that is still very much the case.
And I think maybe to a large extent we can say that the knowledge you build in a sector is more easily transported around the world since it's the same dynamics. So not only has the companies become more global and operate all over the world, but also the very knowledge base is kind of easier to be a specialist within a sector than within a country. And I think maybe that also lends itself to the way that you think about companies actually knowing their activity. It's not knowing the equity market as such. But there are some exceptions. And we actually built a few specialist teams that has a different platform than our main base of dividing our research effort and our investment mandates on sectors. And that is areas where the country factor is very strong and dominant, or where there is a specific team that crosses and spans across different sectors and industries. And two of those would be our China mandates and our environmental mandates. And we have with us today from Singapore our global head of specialist mandates, Sigmund Kyrdalen. And good afternoon to you, Sigmund. When you are looking at this area, let's take the China mandates first. Of course, there is a very strong and different element here with regards to how important the way that things are done in China makes this investment strategy sort of different. I think to a large extent we, of course, have been in Shanghai since 2006 because we think China is so important for the global companies as well. They have lots of their production there, they have a market there for selling things, but also what is happening in China is influencing the world economy. But I think thirdly, our investments in China has picked up quite a bit. They're quite large now and they're growing very fast. When you look at this, Sigmund, and we kind of look at how we're balancing, call it the global angle that we have and all the local factors in this market, how is that actually working in practice?
Yeah, so I think, as you mentioned, China is a little bit different, and you need a bit more local knowledge maybe than in other markets, because first of all, a lot of the companies will only communicate in Mandarin, but also understanding the government and regulation and the culture is very important. So that's why we have a local team in Shanghai. But then at the same time, we do try to apply our global template, if you want to call it that, for how we invest in companies. The ability to be long-term, do fundamental research, and really take into account things like ESG factors to screen out the less good investments.
So the Chinese equity market is also described by quite different venues. The way the market operates in Shanghai and Shenzhen is quite different from all the Chinese companies that we're investing in who's listed either in Hong Kong or even in New York. Do you kind of have a different investment strategy depending on which stock exchange the companies are listed on?
I wouldn't say it's a different investment strategy, but first of all, the behavior of stocks in the different markets are a little bit different on a short-term basis, at least. Because in Shanghai and Shenzhen, you have a lot of retail investors driving the volume every day, whereas in Hong Kong and the US, it's a bit more institutional investors. But another interesting difference is really the composition of the markets. So Hong Kong and US, for example, that's where all the big internet companies that you've heard about are listed. Whereas some of the consumer sectors like food and beverage, you really have to invest in Shanghai or Shenzhen to get a broad exposure to that bit of the Chinese economy.
If we move to our environmental mandates, we say that a China mandate is a combination of local knowledge and our global mindset. The environmental mandate is more like how do you take a theme and look at it across sectors. And of course, our portfolio managers in this area has to be not only talking to and discussing, but being cognizant of what happens with regards to this across many industries. In addition to that, of course, in this area, changes are happening very fast. There's new companies, there's new products, there's different government regulations coming and going. And all of it is based on a change that will take decades. So how does that actually influence the way that we do research in this area?
Yeah, so we have to start with the kind of long-term view of the various themes, because the technologies in many cases are in a kind of early stage of development. So, there'll often be government subsidies or regulation that drives the development and growth of the technologies in question. And we need to understand how that impacts the cost curve and when, these can become kind of a wider rollout, to put it that way, and no longer need support. So that's the starting point, looking into the themes. But then we need to understand the companies, because that's what we invest in at the end of the day. And there, we do research also in collaboration with our sector teams to draw on their knowledge from the same companies.
So more industry analytics, more cross-sector investing, and also focus on the change that will take out during the course of decades with regards to the whole change of the energy complex. Thank you very much, Sigmund, and nice talking to you. So, Petter, we talked about this specialization, but that's really something that we have for all of our mandates, because in one sense, I think active management is first of all about knowing more. And as a background for that, we have to a large extent recruited people who had an analyst background. And we have tried somehow to get these analysts to become good portfolio managers. but it's not obvious kind of how you do that or what you're looking for. So can you give us some insight in the thinking here?
Yeah. If I had a simple answer to that question, I think life would be very easy here. It's having good PMs is kind of the essence here in terms of having success here with creating outperformance. There are many things we do look for, but I think what we emphasize first and foremost, we need talented people with high level of integrity here. We're managing the fund on behalf of the Norwegian people, and they have to trust us. So that's top of the priority list. But besides that, of course, there are other elements. We need people naturally that are smart, bright. They need to have a passion for investing, be dedicated, have grit. You need intellectual curiosity, be open-minded in terms of being a good investor. And kind of tied to that is also, as I talked to earlier, it's a very competitive business that we are in. You will make mistakes here. You need to be humble. You need to be able to build conviction, but you also need to be able to change your views.
So you said that you want people to be dedicated, but in one sense we kind of try to make it slightly easier to the extent that our mandates are not that wide. We like to have people who are focusing on typically 30 companies, just to make sure that they know these companies really, really well. And in addition to that, we are letting them having all individual mandates, so they're fully accountable for how they're doing with their own investments.
Yeah, I think these are kind of key aspects of how we do things here. So we would tend to work, whenever we recruit a new PM, look at what companies should be in their research area. So we're not tied down to any kind of standard industry classification or other restrictions. We will kind of look at what companies make sense to analyze together. They have kind of common value chain. And also, of course, linking it to what the company, the PM brings in terms of prior experience here. So each PM, as you say, will typically follow a narrow set of companies, typically 25 to 30 companies. And this is what we call a research list, a tailored research list that I would say is rather a unique approach that we have adopted here. So then, the job for the PM is basically to analyze these companies, build inside knowledge into these companies over time, and decide which one he should include in their portfolio.
And this research list is also really the funding. I mean, we are carving out from the portfolio.
For sure. So it's we give them a lot of autonomy in terms of the investment decision making, but the whole setup is focused on having a very strong set of accountability here. So we measure, how that portfolio does ongoing against this tailored research list, which is their benchmark and funding here.
So one way you can say that this tailored funding is kind of a predefined short, if you like. So it's a setup that is neither long only or a long short really. It's a hybrid between the two.
Yeah, you're right. So we've tried both long only and we've tried long short structure through the history of these strategy. But as you say, kind of at the end of the day, it is about picking the right stocks here. And what is important is that process in any form is repeatable. So we spend a lot of time and emphasis, and that's been increasing over time, looking and evaluating the investment process of our portfolio managers, and also hopefully we can assist them and develop them as portfolio managers by focusing on the process and making it more repeatable and creating more outperformance.
So I think when we started out in '99, the model was typically for most fund managers that you had a portfolio manager who had a core of analysts coming up with ideas and doing research, and then a set of traders who were implementing it. And to a large extent, I think what we did was sort of saying, well, let's just join the analyst and the PM role here to make sure that the person who knew the most, the analyst, was also the person who made the investment decision. And in the final end, this is about knowing more, as we said, but it's also about investing in specific companies. And sometimes you have to prioritize what kind of information you actually get there. So maybe we should get into the discussion, another person.
So we have another person with us today from London. It's Finn Einar, who heads up our sector mandates. He's been heading up this group since 2011. So hi, Finn.
Hello, Peter. Hi.
So we've talked about the portfolio manager. We also talked about the team structure. But can you actually tell us a bit more about how actually the teams are working?
Yes. So every mandate in the team is individual and with full autonomy. But we do want our PMs to learn from other PMs. And a lot of this learning takes place in the industry teams. So clearly this is important for newer portfolio managers, but also more seasoned investors. They get insights by talking to other team members and being challenged by younger members of the team.
So how actually are the teams structured?
Yes, so we have currently 7 industry teams. They are covering all broad sectors. Typically, we have between 3 and 6 PMs on each team. It's good if you can have a range of experience among the PMs. We also very often have a trainee on the team or an analyst on path to a portfolio manager role. So everyone on the team is quite specialized, but there is overlap in the investment focus, and that is to encourage discussion and sharing of knowledge from the different sectors.
So over time, the importance of the team has increased here, and correspondingly also the role of the leader of that team, the team head. So how would you describe their role?
Yeah, so in the earlier years, we didn't really have a formal team structure, and we didn't really have the team head role. But when we introduced more structure to the research expectation, and also just as the organization got a lot bigger, it was a need to follow up the expectations in each team. But the portfolio or the head, he does a lot more than that. So his day job is to run his own investment mandate. He can give guidance to the newer team members, and he can challenge the thinking of the more seasoned investors.
So really, we are in a business of information management. You need a strategy for that. So how would you describe ours?
Yeah, so we need to develop investment views that are well underpinned and well researched. And they also need to be different from other views in the market for us to succeed. So we need to be critical and differentiated in how we gather information, and we need to focus on information that is important for the long and the medium term, and try to avoid spending too much time on all the noise.
And as already mentioned, the company meetings we see as a very important information source. How do we address those?
Yeah, so the fund and the PMs have very strong access to large global companies, and we have to make the most of it. We have always taken these meetings very seriously. The portfolio manager is the face of the fund to the company, and we want to be valued as a discussion partner.
And in terms of the fund has grown tremendously. We have become, it's fair to say, more well-known among companies here. Is there any way, do we, through these 20 years, do we approach company meetings differently now than in the early years?
Yes, so the much larger size of the fund, it does give us more opportunities. So we try not to just take what's on the plate, roadshow meetings, shorter meetings at conferences. One thing we can do is to reach out to companies, try to meet them where they are based. We can then target, for example, senior management who manage large business areas, or we can just target a wider selection of management. Recently, we've also trained our PMs in how to run these meetings and how to approach the issues with management.
So company meetings, that's what we put as the most important information source. But is there any other information sources that we also look at?
Yeah, so a couple of others I would mention. So one is the use of experts mobilized through expert networks. Our portfolio managers use that a lot. And it's something we can justify the costs of because of the size of the fund. Another area is primary research. So we can gather large data set in a specific area. So one example I would mention here is data for prescriptions and drug invoicing. That can be used to see how a new drug is doing. And that is valuable in developing long-term revenue forecasts for a pharma company. So we are focusing on the long term, but it's also very important to understand what is happening with the company and its products in the short term. And then we can better adjust our long-term views when we need it.
So Peter, knowledge is of course good to have, and company insight is of course something valuable in itself. But in the final end here, we do this to create excess returns.
Most definitely. And if you look at what we have achieved, I think the short answer is yes. Since we started, we have outperformed the benchmark by 1% per year. So that is, now over more than 20 years, and it's been on a very large and growing asset base. So I would say that's it's a tremendous achievement. If you look at it in monetary terms, it is more than 60 billion kroners. So we have achieved clearly outperformance.
Yeah, so 1% excess return on our baseline sector mandates. The specialist mandates, there we have had quite a bit higher excess returns actually.
Yeah, if you look at some of the sub-strategies here, most definitely that we've had higher returns. For instance, China is, I would say, a very fruitful area to do stock picking, and definitely we've done stronger results there.
So many people will say that, in the final end here, active management incurs costs, and the cost you will incur is kind of by nature the same as the excess return you're creating. But that may not be the case for a very large fund like this one.
That's right. That's usually the level of criticism or skepticism. But I think the starting point is that we are part of NBIM. It's a very cost-conscious organization. It's been so since the start. If you look at our costs for these strategies, in recent years they have been running them less than 0.1% per annum. So I think that maybe that is surprising for some that we are able to run that at such a low cost base. So how are we able to do that? We do focus, where we spend our money and do it selectively. And also it's, clearly we've been helped by a very large asset base that we can put in resources, still meaningful resources on research. And that asset base has been growing over time.
So if you look at this last 2 decades, there's something that we should have done completely different?
I think, I've mentioned that several times here, but one of the big challenges has been the tremendous growth in assets here. And we probably over time, felt certain challenge to look at new strategies to complement our core strategies. But again, if you look, the last, what we've achieved over the last 20 years, I think maybe we should have put in more resources, more portfolio managers in our core sector mandates.
So I think with the 70% of our assets invested in the equity market, which is a total of more than $850 billion US, we quite simply have to know what we're invested in detail to be able to understand the risks in the fund as a whole. And that also goes for our single investments. If you think about it, we have quite a few investments now with more than, in a single company, more invested than $10 billion US. So this is, of course, about risk management in addition to creating excess return. In one sense, you can create excess return without increasing the risk. It's rather to understand the risk. And I think maybe the third thing here, And maybe as important here is over time here, we have understood that our ownership role is now so important that we have to take these responsibilities by being such a large owner very seriously. And that ownership effort without the knowledge of these companies would be kind of hollow.
Yeah, I think I would definitely agree with that notion here. That over time we have become, in different markets, particularly in Europe, we are one of the largest owners of companies as a starting point. And to engage with companies in a meaningful way, yes, we are principle based, but you need kind of a foundation of specialist expertise to. I think that's an expectation among our investee companies that we need to engage on an insightful basis here, basically.
So this is about creating better returns. It's about understanding the underlying risk of what we're invested in. It's about taking our ownership role in a good way. But I think it's also about who we are as an investor. We have an accountability, a responsibility with regards to the future generations on the behalf of which we are managing these assets. But we also like to be a welcome investor in the countries that we're invested in and assure everybody that we have a common interest with the companies in future long-term profitable activities. And I think to a large extent this is company insight here that we're building is actually what gives us this. To know more is to understand more. And this insight is knowledge. And finally, knowledge and the attention it gives is a way to safeguard our assets. So in the final end, we build knowledge to get company insight to safeguard our assets for the long term. Thank you for listening in. Today we are publishing a book about our investments in companies. We called it Investing with Company Insight. You'll find it on our website and take a look at it if you have time. Thanks.